Good afternoon, everyone. In today's video, I'll share the short side trade opportunities that we had set up for today inside of our three major index markets. That's the S&P 500, the Dow, and the Nasdaq. Now, the trades that met all of our rules from our trade plan all appeared in that same 9 to 10 a.m. Pacific hour, which is a little interesting. This is the lunchtime hour on the East Coast, and that's where we had our opportunity to take an entry. This was a short entry, and in all three of the markets that we had set ups, all three of them actually gave us winners. The S&P gave us a T1 and T2, the Dow gave us only the first target, and then the Nasdaq gave us only the first target. However, outside of the results, the thing that I thought was more interesting with today's activity was the fact that all three of these trades took place via our scalper models. For those that are unaware, the scalper is our most aggressive volatility model that we have, and it's been pretty much on the sidelines, at least over the past couple of weeks, when we've seen the influx of volatility in the markets. We've tried to be a bit more conservative, avoid using the scalper as much as possible to try and be a little bit more cautious or conservative. But today, that scalper was the model we were using. That was the model we sent out in the morning note. And that was the model that ended up actually giving us entries. Now, to give you an idea of just how muted volatility has been in the markets, at least so far this week, I think the stock platform gives you that best idea. Now, the thing that should stand out here is Jan 24th's bar. Jan 24th was the day in which very clearly we had the most volatility inside of a majority of the stocks. And if we compare that ever since then to, say, right now, Feb 2nd, you can see that volatility has declined fairly rapidly. Now, in my opinion, this is more of a quiet before the storm. The muted volatility, I think, will start to pick up towards the end of this week and into next. But this gives you a visual representation of how volatility has really progressed since Jan 24th and even before the 24th. Now, if we start by taking a look at the futures market's results here, the S&P 500 was the one market in which we hit both targets, the first and second target, but they're fairly close in terms of the point structure. The first target gave us a plus 8.25 points. The second target gave us a plus 9.25 points, and you could have used either the full size or the micro contract. Now inside of the Dow, we had just the first target hit, and that was a plus 56, and the second contract was taken off at break even. So not as nice as the S&P, but still nice in the sense that we had a winner here. Finally, the third market that we'll talk about in today's video was the Nasdaq. Again, you can trade that with the full size NQ or the micro MNQ. That also gave us only the first target, plus 33 points on that first contract. Second contract stopped out at break even. So the S&P was the only market that gave us a T1 and T2, and the Dow and the Nasdaq were good for just their first targets. Now let's take a look at our charts here to get a visual representation of each of these setups, but I'll start with discussing this platform here, the Stock Volatility Box's scanner analytics, which I think really shed some light and I think is one of the more interesting aspects of the volatility that we're currently seeing. Now, let me drag over our platform here before we start by taking a look at charts. So this is on our Volatility Box homepage inside of the stock platform. This is where we try and capture data around each day's trading activity to give a better visual representation. And the thing I'd like to focus in on is this 15-day scanner analytics. Now here, the peak that we were talking about was Jan 24th, where we had 1,736 different trade setups that hit the live scanner. That's incredible. We don't usually see numbers that high. In fact, the numbers we're used to seeing more frequently are in that sub 250 range. You'll see Jan 13th was about 206, Jan 14th 173, Jan 17th that volatility dropped off, about 36 trades only. That number changed, more or less hovered around that sub 250 area, but we then broke above it with Jan 20th, and then that volatility just continued to keep increasing. Jan 25th, 803 different setups. You compare that to today, just 80 different setups that hit the live scanner. And I say just inside of quotation marks. That's still a lot of different trade opportunities that you can pick and choose from. And just yesterday, Feb 1st, we had 146 trades that set up. So overall here, you can see that volatility since the 24th has declined a little bit. And I expect to see this start to increase just a little bit more as we progress through the end of this week and head into next week. Now let's come into our charts here and take a look at the different setups that actually took place today. I'll start with the S&P here first. I'll go through this fairly quickly, but if you haven't seen our video in which I cover the rules of the setup, I'll leave a link to that in the description box as well. Now inside of the S&P, the first breach we had of our volatility models was in that 8 to 9 a.m. hour. You can see price fell into our sign entry lines, and we bounced from there without really getting an opportunity to enter. So all this does is gives us the confidence that, hey, so far the scalper is being respected inside of the S&P. And this was true in the other index markets as well, as you'll see, but let's continue focusing in here on the S&P. Now moving in, that 9 to 10 a.m. hour is where we actually had trades that met our rules. The first part of our rule is breach the sign entry line. That's this line right here. We had that breach with this green candle, so that's step one where we met that part of the rule. Once we have that breach, we'd like to see our oversold confirmation, this red arrow, since we're looking for a short opportunity. We had 1 and 2 different red arrows, along with an opportunity to enter at the sign entry line. So that's step 2, and that's where all of the rules of the setup are met. At this point, our entries at the sign entry line, our stop is outside of our volatility box clouds, and our first target is that same bare minimum move that we were looking for, which in the S&P was that 8.25 points. We had that same target on the downside, so 8.25 points. And our second target was at this gray target line on the opposite side, which was hit in this down move, which was one additional point, 9.25 points. To give you an idea, just so you can see this with the trend line tool, outside of the clouds, 8.25 points to the actual target line, 9.25 to 9.5 points, depending on where you took off the trade. So that was a trade inside of the S&P, and if I zoom out here, after then we really chopped around sideways inside of our clouds until the very close where then we had a nice little sell-off after the bell actually rang. Now next up, let's move on to the Dow. So inside of the Dow, a very similar setup here. 9 to 10 a.m. hour, we breached our sign entry line. We had the edge signal confirmation in the case of the Dow. You had a better entry than even the sign entry line, so that means reduced risk. But I've still used that 56 points from our sign entry line. Depending on where you got in, you were actually able to cut that risk down by right around 25 points, 25, 26 points, which allows you to basically cut the risk of this trade in half while still going for that same T1 level. And very similar to the S&P here, the Dow had a nice little flush move down lower before reversing into the actual close before we then had that final puke as well. Now next up, we have the Nasdaq. The Nasdaq looked a little bit more similar to the S&P in that we also had the breaches in the 8 to 9 a.m. Pacific hour where we bounced, but our rules weren't met. So that just builds confidence that, hey, we're looking at the Nasdaq on the scalper and it's being respected. The next trade that actually happened, the next breach rather, was when price action breaches the sign entry line. So this is step 1. We have the oversold confirmation signal, the red arrow. So that's step 2, along with an opportunity to enter at the sign lines or better. You did have a bit of heat on the Nasdaq trade. Stop was outside of the clouds, did not get hit. And then we had that same nice reversal inside of the Nasdaq, and we were looking for that same 33-ish points inside of the Nasdaq. We went all the way down to about 53 points, but fell just a little short of T2, which is at 59 points from our sign entry line. Now, after that trade, we had another breach where we saw a bounce, didn't get an entry, but the one place where we did have another entry in the Nasdaq was in that 11 to 12 p.m. Pacific hour where we had a breach of our sign entry line. We had our oversold confirmation signals. We had an entry at the sign entry line. We had a little bit of a flush move, but that did not hit T1. We then bounced up from there and basically chopped around sideways into the close where you had an opportunity to take that off at basically a net break-even trade. And that final puke came after the bell rang, so it did hit T1, T2, whatever you want to call it, but that was after the bell, and I wouldn't really consider that part of the same trade. But for those of you that did stay in it, you had T1 and T2 for additional gains there inside of the Nasdaq. So hopefully today's video gives you an idea of how the different volatility progressed in the 3 major index markets. And more importantly, the fact that they all happened on our scalper is the one that I find most interesting here, bringing back the stock volatility boxes platform, the scanner here. This is the thing to keep an eye on, in my opinion. Start to see how this volatility picks up as the week progresses, as well as into next week's trading activity. All right, hope this video was helpful. Take care, everyone. Good luck trading, and we'll see you in the next update.